that mindset, that confidence that in the end stock markets are fair and you do your analysis of the businesses and then stay put.
In the 90s, what was the mutual fund industry back then?
We used to spend most of the time in just collecting information. We would spend bulk of our time in investor meetings just explaining the nature of equities. Over time, lot of factors have played why this industry has evolved so well. I think the regulator has played a incredible role.
How did you manage to stick to your strategy with conviction and consistency over so many years?
Thinking long term, thinking in very simple terms, and often focusing on the second order impacts. The need to diversify is very important. Diversification is humility applied to uncertainty. The best investments are made in the worst of time. And the biggest mistakes are made in the best of time.
What is your view on retail investors having a part of gold in their portfolio?
Gold is akin to an insurance.
What's one unconventional investment lesson or learning that you can tell us which no book or MBA will ever teach us?
Common sense over spreadsheets and EQ over IQ. Mr. Buffett has said that equities are a device that transfer money from the impatient to the patient.
Yeah.
Hi everyone and welcome to another episode of Happy Hour with FinCocktail. Our guest today is an alumni of IIT Kanpur and IIM Bangalore and has over 3 decades of investment experience. He was the Chief Investment Officer at HDFC Mutual Fund where he managed over 1 lakh crores in equity assets. Under his leadership, he managed to grow the AUM for HDFC AMC from 3,000 crores to 4,40,000 crores. He holds the rare distinction of being one of the only fund managers in the country to have continuously managed a mutual fund scheme for over 28 years. Known for his sharp market insights, he has now navigated multiple market cycles. He's now on a journey with 3P investment managers where he brings his deep expertise into long-term investing. Let's welcome Mr. Prashant Jain.
Welcome to the show, sir. It's great to have you. We're very excited to know all about you. I want to start a little bit to get to know you from the beginning. So you are an engineer and then you switched to finance at IIM. How did that switch happen and how did your engineering background kind of help dictate your philosophy in investing?
So a lot of my decisions have been taken by avoiding things which I did not want.
Okay.
So after engineering, I did not want to go abroad. I did not want to work yet. And I did not want to pursue higher studies in engineering because I thought you did not have too many good options.
Okay.
Like MTech program in India those days was not very well accepted. So that's how I thought, let me try and do an MBA, and that's how I went to IIM Bangalore.
Nice.
Engineering has certainly helped me be a good investor, because what engineering teaches you is to analyze things, and you don't have, an engineer is not supposed to have any biases. You have a problem solving approach, and whatever is the solution, if you followed the right process, right logic, then you say this is the right solution. So I think that approach, that mindset, that confidence that in the end stock markets are fair and you do your analysis part of the businesses and then stay put. So I think that has had a deep impact on my investing career.
And if you had to describe your IIM Bangalore experience in an investment metaphor, what would it be?
Investment metaphor. I would say it's not an investment metaphor, but one way to describe it would be the dessert after a wholesome meal. So it can't replace the meal, but it adds value to the meal.
Lovely.
Nice. Very interesting. That's the first time I've heard an MBA being described like that.
The dessert.
So your career began at SBI Mutual Fund, if
That's
I'm
right.
and in the 90s. What was the mutual fund industry back then? Because it was vastly different, right? And mutual fund Sahi Hai sometime began around that time?
The campaign came much later, maybe I think maybe 10 years back.
Yeah.
Mutual funds were a very pale shadow of what you see today. There was hardly any funds actually.
And people were so skeptical about mutual funds also, I believe, in the late 90s.
Not just about mutual funds, they were skeptical about the stock markets. So my mother-in-law told my father-in-law, I was not married then, are you sure? He works in stock markets. So that's a reality.
Not a stable job.
So stock markets were very speculative. Mutual funds were in the infancy. And I don't think you can compare these two. The core structure was same, but the size was much smaller. The pace of information flow was very, very slow. We would get stock prices in the evening through a bhav copy, which you used to buy a physical copy. Otherwise, during the day, you don't even get to see the prices. And mostly the funds were closed-end funds. So there was no day-to-day monitoring. Even NAVs were not calculated every day. So it was a very, very different industry. We used to spend most of the time in just collecting information. You could, wherever you get your hands on an annual report, you would try and get it. Some people would even go to scrap dealers and buy annual reports by the kgs, or you would go to a stock exchange. So I think it was quite different. Equities were not well understood at all. We would spend bulk of our time in investor meetings just explaining the nature of equities. Today when you meet an investor, you don't explain the nature of equities. You will discuss many other things, but not the basics. Those days 90% of the meeting would be just explaining the nature of equities.
It must have been very hard to actually convert those clients, right? Because you're just explaining what it is, basically.
So I think yes, it was not easy, and I think over time lot of factors have played why this industry has evolved so well. I think the regulator has played a incredible role. NSE came along the way, SEBI came, then you had open-end funds, you had daily NAV, loads went away, expenses have dropped, KYC has become a lot easier. The media, the distributors, mutual funds, everyone has played a big role in educating the investor. The mutual fund Sahi Hai campaign, again, I think hit a chord with the common man. So I think it's been a journey of progress of the country, of the stock markets, of the industry, of the regulator, of the digital adoption, of media. So I think so many individuals like you have joined the bandwagon, and you have taken that understanding to far and wide. So I think all of this has come together.
Right. Moving a little bit forward in your career, you are one of the only fund managers in the country to have continuously managed a single mutual fund scheme for about 28 years. How was that experience, and how did you manage to stick to your strategy with conviction and consistency over so many years?
No, I think the strategy was not consistent. It kept on evolving. I kept on learning. But yes, I stayed put with the same fund despite it having changed owners 2 or 3 times. And my logic was very simple. I said, if you have to go and manage a fund somewhere else, then why not run with the same fund? And I said, if I do a good job here, then even if you change and you get maybe 10-20% more, I'll get it here, but maybe a year later. So it is not such a big difference. And finally, I think I also wanted to create a long-term track record. That thought was there right at the beginning. Okay, now that you are running this fund, let's manage it for a long period. So I think these are few things which helped me stick despite considerable changes in the ownership of the business.
You've seen so many market cycles through your long journey from the tech boom in the 90s to recently. We've seen way too many changes happening, including the digitization of the financial markets. How do you, what strategies do you use to kind of identify these trends early to make sure that, you're staying on top of things?
See, in the end, the thought process is not difficult. But what is difficult is the belief in your thought process. So let's say when technology was very expensive, it was 600-700 Ps. Everyone knew it's very expensive, and people simply extrapolated the growth rates of that of the past. And I focused on we did not know how long can the IT industry grow, because we had no clue of how large the US industry is. I mean, we had no understanding. So one just thought, you focus on the second derivative. So if this happens, then what happens? So if the IT industry grows at 60% a year for 5 years or 7 years, then that number became so large. It was a massive number relative to the size of the economy then. And then it was evident, if it indeed happens, then the rupee will appreciate massively, because India would have been a hugely current account surplus country. So that told you, look, we don't know whether growth will be there or no, but if it is there, the profitability cannot be there because rupee will appreciate significantly. So I think it is always thinking long term, thinking in very simple terms, and often focusing on the second order impacts, which give you a hint as to what the market is discounting. Is it likely to happen or not?
Now, long-term investing, as we all know, requires a lot of patience. Can you tell us about a particular stock or a particular market sector that sort of tested your resolve and ultimately paid off?
Well, there have been many such cases. There have been stocks which have once in a while gone up 10x in 1 year. And there have been also stocks which have done nothing for 5-10 years. So I remember we had bought Aarti Industries and we had bought Sun Pharma. And these two stocks refused to move. And they, almost, I think, 5-7 years. But businesses were doing well, nothing was wrong with them. They kept on becoming cheaper. And we held on, and in the end, they made up for the entire period of underperformance. But it was possible to hold on to these stocks because they were weights in a portfolio. They were not the portfolio themselves.
Correct.
So this also tells you the need to diversify is very important. If you are holding half your portfolio or 1 quarter in a single stock, then you will be under immense pressure, immense pain. But if it is 2, 3, 4%, then it is more manageable.
Right. Now, since you've spoken about diversification, can you tell us a little bit about over-diversification? When does that really sort of happen, and how does that affect your portfolio?
So I don't think you will get an exact answer to this, and different people, different points of time, different market conditions, the right answer could be different. And it would be very hard to figure out
at what point it becomes over-diversified?
In foresight,
Yeah.
what is right and what is wrong. That is the nature of this industry. Still, I think diversification is very important. So I don't know who said this, maybe Mr. Buffett said this, that diversification is humility applied to uncertainty. So in investing, you are dealing with the uncertain business conditions, markets, macroeconomic outlook. So it is always good to be diversified. How much is good? I don't think there is a right answer, but what I have practiced is that diversification, the degree of diversification in my portfolios has been a function of the opportunity set.
Okay.
If you come across some significantly superior opportunities, then you remain less diversified and you put a lot more money behind those opportunities. You are still diversified.
Correct.
Yeah.
But more conviction with some.
You will put larger, because the risk reward is more favorable. So there, if the valuations are more skewed in one area, then you will tend to put a lot more money in those ideas. And in today's market conditions, for example, when deeply undervalued sectors are very few, businesses are very few, then there is less merit in being less diversified. So in such market conditions, I think you are not losing out much by maintaining that extra diversification. So in these conditions, I think a little higher diversification is better.
You mentioned the current market conditions. Now that we've come here on this topic, a lot of people are saying that compared to our country's GDP, our stock market was overvalued. It's corrected, but it still remains overvalued. What's your opinion on that?
No, I think markets have come to fair valuations. So especially the large caps. I think the small mid companies are still quite expensive, and the risk reward, to my mind, on small mid caps as a category is not good. They are probably still overvalued, but large caps, which are roughly 2/3 of the market, I think are at quite reasonable levels. What that means, however, is that while we should make money, that return should be in line with the underlying economic growth. Economic growth in India in rupee terms is around 10-11%. So I think those are the sustainable returns. 10 to 12% are the sustainable returns in large cap indices, medium to longer term.
Interesting. And how long do you think this volatility that we're experiencing right now is going to last?
See, volatility by definition means both way price movement, but
Yeah.
most people, for them, volatility means
Negative.
only negative. So I think stock markets are always volatile, but if you are referring to a downward trend, I think large caps should stabilize. I mean, there is reasonable value now,
Yeah.
and reasonable value does not mean that they cannot become undervalued.
Yeah.
But I think what it also means is that if you take a 3-year view, I think 10-12% CAGR is sustainable. Why I am a little more optimistic on the markets now is because the primary markets, the IPOs that were sucking out a lot of liquidity, I think the volumes being raised there will come off very sharply. And that is because a lot of money has been lost in issues that went public in the last 6 odd months. So with that experience, I think the appetite for new issues would be sharply reduced, and that money which was going there, I think will start getting deployed by large investors, mainly the mutual funds in secondary markets.
Nice.
And that's why I think the indices should probably stabilize.
Moving back a bit, during your time at HDFC, you managed to grow the AUM from 3,000 crores to 4,40,000 crores. What were the key factors behind this phenomenal growth?
So a small correction there, I did not manage to. It grew.
It grew.
It grew. So I think everything fell in place. The economy was doing well, and a lot of hard work had been done in the previous 20 years by all participants. So, and that I also joined HDFC Mutual Fund in 2003, and markets had not done well for 10 years. For 10 years the index was flat. They were deeply undervalued. So that was the beginning of a very big major cycle in Indian stock markets. The regulatory framework was much better, and that period also coincided with China joining the WTO. So what that meant is that the commodity prices went up very sharply in that period. So there was a cyclical recovery in profitability in India. Commodities went extremely well and markets were very cheap. So the index did extremely well in the run up to the Lehman.
Correct.
So I think strong returns always attract people, investors. So I think that was one key reason economy was doing well. The distribution was getting more organized. Banks were now getting mutual fund distribution had emerged as a key business for them. And banks, as you know, have huge distribution. Prior to that, it was mainly brokers, sub-brokers, IFAs. And I think most important in the same period, all funds did not grow. HDFC Mutual Fund grew. So I think that brand is synonymous with trust. It's a unique brand. It appeals right from the blue collar to the ultra HNI.
True.
So I think all of that came together, and I think the team also did a good job. Our returns across products were pretty strong. So I think the macro environment, the stock market's doing well, the regulatory framework, distribution getting organized, the HDFC brand, and of course our performance, all of this is what resulted in that big growth.
Nice. And managing such a massive capital, what did it teach you about investor behavior? Because we've spoken about risk and diversity and of course the factors that played into it. But what about investor behavior? Because to me that's very, very interesting.
See, investor behavior has by and large remained the same. Information is more. There is, you can trade on your mobile, but investor behavior, human psychology is the same. And that is why experience counts.
Yeah.
So that is, I think all human beings are influenced by fear, greed and hope.
Yeah.
And we have seen that this is the fourth time I have experienced what has happened recently. So it is very hard for those who are on the wrong side, but what has happened is not surprising to me. So I think we continue to, a new generation of investors is born every 5-10 years who don't have experience of previous market cycles. They are conditioned, they are driven only by their recent experiences.
Yeah.
And they don't want to believe or listen to anyone else. Because your own experience is telling you something very different. And for these investors, it is simply extrapolating the last few years into the future. And in the end, you create an excess and you pay the price. So I don't think managing large sums of money has got anything to do with learning this. But anyone who observes markets and cycles over time will say probably the same thing.
Getting a little bit into the micro aspect of things, what is your approach towards stock selection and what are the fundamental sort of few things that you look at in a company while making it a part of your portfolio?
See, the answer is extremely simple. But when you really get down to analyzing a business, it becomes far more difficult because we are all dealing with the future. So the great business to be bought, the best business characteristics are a business which has significant growth potential. It has huge entry barriers. It does not need capital. It can grow without capital. And it is very cheap.
But that's the ideal situation.
That's like the dream.
So you asked me, what do you look
but
for?
No, what are you, when you decide to make a stock a part of your portfolio, everything is not always going to be so ideal.
Yeah.
So you start compromising based on this is what is the ideal thing. Then you look for same characteristics. I can't buy huge growth, but let me buy less growth, what is available. A business with great characteristics is terribly expensive, so let me go to a... So basically it is these four factors. Yes, this business can grow, but it is capital intensity, but still its ROE, ROCs are reasonable. Sometimes even when a hugely cyclical, very capital intensive business is available very cheap, you may still buy it.
Yeah.
So that's why I said the answer is very simple. But when you actually get down to doing it, it is very difficult because everyone is aspiring for that.
Same thing.
So businesses are often priced to perfection. Some cases priced to misperfection. I mean, they are very expensive. So you are looking for those imperfections, and it is rare, and it will happen only in deep market downturns. That you will get a business with a great runway for growth, low capital intensity, significant entry barriers, really cheap.
Right.
And that's why one has experienced what is often said is that the best investments are made in the worst of times. And the biggest mistakes are made in the
best
best of times. Like what has happened last
Last
6 months.
Yeah.
Right. If there's a particular sector of the market that you've always found very interesting and you like studying and, sort of researching more and more into that sector, can you tell us a little bit about that?
No, I don't think there is any sector which has been interesting over time
Throughout.
periods, because if a sector is good, the price may not be right, and over time the growth characteristics of a business change. Let's say when I moved out of campus, the penetration of consumer staples, shampoos for example, was extremely low, maybe 10-20%. But today they are penetrated 70, 80, 90%. So the growth characteristics have changed.
Right.
So I don't think there is any business which remains equally attractive across cycles. In this market, all I can say is that the large caps appear to be offering far better risk reward than small and mid caps in general terms.
And what would you say to somebody who's a long-term investor going through this cycle but is new, like somebody who's just a part of this new generation of investors, has experienced this last 1 year of ups and downs, and now is maybe panicking, maybe not, but is wondering what to do as a long-term investor, as a potential long-term investor?
I would say first of all that please read, please understand.
Yeah.
So you may not have seen those cycles firsthand, but they are all documented.
Yeah.
And so please read those cycles, please. And there's a lot of good literature available on market cycles. So you can read that. You don't have to wait for 20 years to live it, experience it firsthand. And so I don't think market cycles or investor psychology changes. So what has happened before is likely to repeat itself. And all the signals, signs are virtually the same. So I would say, the core of investing is something very simple, that buy good businesses at reasonable prices, remain diversified, remain patient.
Nice.
But what is a good business? What
a
is the right
reasonable
price? These things depend on individuals as they see those businesses, and they also depend on how the future evolves. Because market forces, market structures, technology, all of this can undergo a change. So what is a conclusion today may change after 3 years. For example, linear television was a great business 10 years back, 20 years back. But now consumer habits are
Completely
changing, they are fragmenting. So your view of the business has to change.
Okay. Gold has been sort of gaining some popularity in these volatile times, as it always does. What is your view on retail investors having a part of gold in their portfolio from a
So
diversification
first of all, I am not an expert on gold, but what I understand, or the way I look at gold, is that stocks are probably a better investment. But gold is akin to an insurance. So if you are in a country or in a situation where the country is passing through very tough period, economically, politically, geopolitically, whichever way, let's say you are one of those countries where there is chaos all around. So gold is one asset which will still hold on to its purchasing power. Everything else, real estate, stocks, bonds, everything will lose value. But gold will hold on to its purchasing power. So I think a little bit of gold in one's asset allocation is good. But I think stocks longer term will create more wealth, assuming the economy and the businesses continue to do well.
Nice. Moving away from the market conditions a little bit and taking a little bit of a closer look at your journey. Right now you are on this great journey of starting, actually you've already started in April 2023 if I'm not wrong, 3B Investments. What is your vision with that business? And you left HDFC after a very long time. There must be a big change.
So there is no grand vision, there is no grand mission, to be very honest. So you just
want to create some wealth.
No, I don't think so. So do the right things and wealth should follow. So I mean that's how I have always experienced, always
That's your philosophy.
thought about life. Yes, and I think we want to be a disciplined, long-term oriented investment firm, and we hope to attract investors who are long-term, who are patient with investing, and hopefully add value to them. So we don't have a target in mind. We want to do the right thing, and let's see where we go.
Nice.
The Indian investment landscape has been evolving quite rapidly, and now there are so many different sort of investment opportunities in the market with REITs, InvITs, even international equities. Where do you think they stand in the portfolio of a retail investor?
I think REITs and InvITs are somewhere in between fixed income and equities. They have the characteristics of relative stability of cash flows of fixed income, and if managed well, they should also have some element of growth. So I think that is how an investor should look at it. Slightly higher returns over fixed income and marginally higher risk as well. But a lot depends on the manager also.
Correct.
As far as international is concerned, I think a generic answer is very difficult. Because international means all other countries other than India, and they can perform very differently.
But does it merit to have some exposure to international equities? Maybe US equities? I don't know. Just thinking out loud right
See,
now.
it is all about understanding. So, not all markets are doing well, and people tend to chase the markets that have done well.
Previously.
So, last 5 years, people are chasing US tech. Now, probably they are chasing China. So, I think that way, I don't think the outcomes will be very successful. Because by the time a trend, a momentum is established, you are probably, things are quite expensive. It may still run for a while, but after 3-5 years, and if you invest without knowledge, you won't know if you made money, why you made money, if you lost money, why you lost money. So it is not something which you can do in a sustained manner. So I think the key to international investing is also the understanding. So in investing, if you don't understand, stay away. So there are two types of mistakes we make in investing. One are mistakes of omission and the other are mistakes of commission.
Okay.
The mistakes of omission are those, I have not bought many stocks which have done exceedingly well. That's okay, that will always happen. So some markets may do well outside India, I don't buy them, it's okay. But the second are the mistakes of commission, which are far more serious. What you buy does not do well. And those mistakes you can avoid only if you understand what you are doing. So I think if you want to invest outside India, do it by all means, but not without understanding. So which means there is considerable work involved before you go out there. If you simply want to diversify from currency or rupee based assets, you can do it simply by buying US treasuries or by buying gold. So if diversification is the only intent, but if you want to earn money, then you must have a view on the underlying businesses. Otherwise, I don't think the outcomes will be pleasant all the time.
Right. But does it then make sense to sort of invest in just an index fund of a particular
like the S&P
international
500.
index?
It is the same. See, an index also an index may underperform for 10 years or country specific index may do exceedingly well unless you say, I will buy the world index. But if you buy the world index today, I am told the US market cap is 70% of world market cap. So essentially you are buying the
US
equities. So unless you have a specific view on the underlying companies, I think even index investing may not be
Prudent.
Interesting. What would you say to a young fund manager or young aspiring fund manager who wants to do well in the field and obviously wants to learn from your experience?
So I would say don't extrapolate the careers made in last 30 years
Okay.
in this industry, because people like me have done well largely because we joined an industry in its infancy. And if you join an industry when it is in the evolving stages, and if the industry grows, early professionals will do
Well.
exceedingly well. So that is what has happened to some of the people of my vintage in this industry. It was not a preferred career by then, mind. So I would say do not extrapolate this. If you love investing, it is a good career.
Yeah.
But do not extrapolate these outlier cases or few cases of success, because it is mainly for the reasons which I shared with you. I think today the mutual funds are much bigger. The systems, processes, risk management, oversight is far more than what it was 20, 30 years back. So the latitude given to PMs is much smaller. And you will become a PM much later in your career. I became a portfolio manager at the age of 25, 27.
Oh, wow.
Wow. Most of us are just getting started with our careers at that age.
Because then no one wanted those jobs.
Yeah.
So I don't think that is likely now.
Anymore.
It will take much, much longer for you to become a PM. So investing is good, but they should understand fairly well as to how mutual funds work. And if they like it, they should pursue it by all means. But please understand where the industry is. And industry is very evolved. There are large teams inside. So to that extent, progress will be slower.
Slower.
What's one unconventional investment lesson or learning that you can tell us which no book or MBA will ever teach us?
Unconventional.
Yeah.
You've already told us a lot of these, but a little more.
I think an MBA will not teach you common sense.
Oh, yeah.
And MBA will not teach you emotional stability either. And these are two things which are most important in investing. It is common sense over spreadsheets and EQ over IQ.
Yeah.
That is how Mr. Buffett has said.
Yeah.
So I think an MBA is not a ticket to success in investing.
I agree. An MBA is not a ticket to success, but de facto anywhere.
I feel like it's more about just the time spent in the market also that teaches you a lot more. You know,
Yes, you have to have lots of common sense.
Yeah.
And
I think you have to get your hands dirty a little. You have to get in there, understand what's going on.
some people learn faster and because there is an aptitude you
Yeah,
have.
100%.
Like someone could be a great painter and someone could be a great musician, but
Yeah.
you may struggle with it for 10 years.
Yeah.
So I think I've seen there are some people who are naturals at this and who will pick things very fast, and some will continue to struggle. So
for a
time alone, I don't
May
think
not be
will
enough.
make all people good in investing. But yes, if you have lots of common sense, a commercial mind, if you focus on price, are willing to undergo pain, and I mean basically when markets are cheap there is panic, and if you are greedy, and
Yeah.
when markets are doing exceedingly well,
It's
there is
expensive.
less fear and more greed. If you can think in a counter cyclical way, I think these are traits which can help you to do a lot better.
Better. What's your opinion on the new digital currencies that are coming out? The bitcoins of the world, the new trends that are, a lot of the new generation is getting into it, but it's still unclear where the future will be for that.
I wish I knew. To be honest, I don't know.
Fair
But
enough.
I'll stay away from it personally.
Right. So now I'm asking from the perspective of most of our viewers who are people who've just sort of started their careers. They have no sort of investment experience whatsoever. You know, they're learning by reading, by listening to podcasts, by, things like that. If they were to start building an investment portfolio for themselves, what should that comprise of and how do they start?
So I would say if they don't understand much about investing, they should put 90-95% of the money in mutual funds. And the balance 5-10%, they can start investing on their own. If they do extremely well in the first 1-2 years, they should not extrapolate that. It could be pure luck. If they don't do well in the first 1-2 years, they should not get disappointed.
Fair.
And mistakes teach you a lot more than what success does. So I think learn with small amounts of money. Small mistakes are something which you can digest. But what people do is they make big mistakes relative to their wealth.
Ability.
So I think that is what should be avoided. And once you have done well for number of years, hopefully preferably over a market cycle, that is the time you can start deploying more money on your own.
There's this trend recently where everybody's getting very impatient. You know, your attention span has gone down. Everybody's like, you want quick money, you want
quick
it
results,
now. Everything, you want it immediately. You have apps that, you can trade with immediately. The moment market corrects a little bit, they're like, no, sorry, sell it, let's get out. Do you think that this is going to, of course, make less patient investors? Do you think fewer people are going to, in the long run, be able to create that kind of wealth?
I think Mr. Buffett has said that equities are a device that transfer money from the impatient to the patient.
Yeah.
So I think more people like that out there, they will deepen the competitive advantage of people like me. So I think equities need patience.
Yeah.
They need patience. So that's why I said EQ over
IQ.
Right understanding, discipline and loads of patience.
Nice.
Over the years, I'm sure that in your career you may have made a couple of bad investment decisions that you've now learned from. Can you tell us a little bit about that?
No, it's a long list. It is all documented.
Chalo, hush. I'm like, okay, it's okay. It's okay to make mistakes.
No. Yeah, all of us make mistakes.
Yeah.
The key is to make mistakes which don't kill you.
Yeah.
They only hurt you. So I think I've made lots of mistakes, but the sizing of those bets was by and large quite small, so it was okay. After having spent so much time, I think most mistakes, I would say, are mistakes of investing in weaker quality or poor quality businesses. 9 out of 10. Only in 1 out of 10 cases you have invested in a good business and still not done well over long periods of time. I mean, you may make less money, but at least money does come back. So I would say almost all mistakes are of investing in weaker, poor quality businesses.
Nice. Where do you see our country going in the next 5 to 10 years, let's say, in the next decade? Where do you think our strengths will lie and where do you think we may need some working on?
No, I think India is on a very good wicket. We have good demographics. We have several competitive advantages going for us. Smart people, young people, lower costs of doing compared to outside India countries. And we are good at technology. We are good also at creative things. So I think India should continue to grow around 6-7% a year. The volatility of India's growth is one of the lowest in the world. We are a stable democracy. If you look at many other countries, the pain what they are undergoing because of weaker governance, weaker political structures is immense. So I think the rule of law, socio-political, economic stability, we take it for granted, but look outside India and you will see there is so much
Yeah.
Of course.
challenges. So I think I am optimistic about India and we should continue to do well.
If you were to share one golden rule of investing, what would that be?
Never borrow and invest.
I love that one.
Perfect.
That's like a great mic drop moment. That's great. I think, thank you so much
pleasure.
for taking out the time and having this conversation with us. I think
Pleasure,
our viewers are really
It
going
was
to
a
enjoy
lovely
it.
chat. Thanks for doing
Thank
this.
you so
Pleasure,
much.
pleasure.
Thank you so much for listening or watching this podcast. If you have any questions, let us know in the comments. And don't forget to like, share, and subscribe. And we'll see you in the next one.